But good afternoon, everyone. Thanks so much for joining us today. We really appreciate you taking the time. We've got a great group of people who have now dialed in, and hopefully today this will be a very informative presentation for everybody, giving everyone a quick update as to how we've been doing in the Jewish Foundation so far this year, and also answering any questions that you might have about the performance of the foundation, of the fund, and anything really else that comes to mind. We have a team of people who are here and who are looking forward to answering any questions you might have. So people are just coming on, and as they come on, I want to just flag for everybody that throughout the presentation today, we are looking forward to receiving your questions. You can submit your questions using the Q&A button. You see the information in front of you on the screen. And after the webinar, if you have any other questions, please never hesitate to reach out. You can reach out to your philanthropic advisor, who's your normal point of contact at the Jewish Foundation, or always please feel free to send any questions you might have to jewishfoundation@ujafed.org. So again, throughout the call today, and we will have some time allocated to answering questions towards the end of this call. And again, save any questions you have even following the call, and we're happy to be in touch. So today on our call, I'm going to provide you with a quick snapshot, which is an update on the performance of the foundation and some of the incredible work that the team at the foundation has been doing recently. And then we're going to go into the main part of the call, which is really to hear from Stacey Rosen, who has now taken on the role of chair of our investment committee, our investment advisory committee, and also from our colleagues at Mercer. And we'll talk a little bit about the foundation investment strategy, the market outlook, how we've been performing, and to answer any questions that you might have. And for those who I haven't had the opportunity to meet yet, and I see who's on the call, I think I know most of you, but for those who I don't know yet, my name is Sarah Lefton, and in addition to working very closely as the CDO of UJ Federation, I also am the executive director of the foundation, and I'm working very closely with many of our fund holders and our Jewish Foundation team, and really thrilled to be here doing this work and with all of you today. So without further ado, I'll get into some of the highlights this year for the foundation. We've had a very, very exciting year of growth at the Jewish Foundation this year. You'll see in our numbers that are on the slide right here, we've had an 11.5% investment return. We're very, very pleased with that return, and it's been consistent from last year to this year with increased growth. You can also see the number of $98.9 million in contributions, which again, if you're someone who's been working with the foundation or involved with the foundation for years, you'll see that that number is going significantly up now year over year. And then when we look where we were a few years ago, really we were looking at contributions of closer to $50 million. And now consistently we're looking at numbers that are around 100 to 110, $115 million a year, and hoping again for more growth this year. This year, another big difference you will see in the numbers is that we're at $73.8 million in distributions. And again, I mean, we take very seriously the need to grow the amount of AUM that we have, or the AUM that we have, and to make sure that our investment returns are always stellar. But we also look at this number as a very serious indicator of how successful that we are, which is how much money fund holders, you, are distributing to community priorities, and how are we actually making an impact where there are significant challenges, both in the Jewish community and the community more broadly. And so looking at that number alone, we can see that in past years, the number has been just over $50 million, consistently year over year. And now we're looking at more than $73 million in distributions to community priorities. And that means that our fund holders are more active. Part of that is because they are much more engaged with their philanthropy. And post October 7th, that had a very big impact on how much our fund holders wanted to distribute and how active they were in sort of researching new projects and looking for new priorities. But it's also a result of the online platform that many of you are using, which has made everything a lot easier in terms of making these distributions quickly, efficiently, and so on and so forth. And so you'll see that number continue to rise. And for us, again, that's a key indicator of success in the foundation, because it means that fund holders aren't just earning significant returns on the charitable dollars that they've put into their funds, but it means that the money is actually being put to work, and it's actually creating impact, which is a fabulous, fabulous thing. The last number that I'm going to share with you here, which is on this slide, is $0.8 million, which is our current AUM. Actually, to be honest, this number was end of year. We now are sitting closer to about $950 million in AUM as of today's date, because we've had a very, very good couple of weeks in the foundation. And that $950 million is not including planned gifts. Once we include committed planned gifts that are coming to the Jewish Foundation, we've now officially surpassed $1 billion, which is truly a remarkable number. And it's been a huge amount of growth in the last few years. So to all of you who have participated and who have helped us either as volunteers or as fund holders or donors or people who have set up legacy gifts or planned gifts, we are deeply grateful, because this is a real accomplishment to have a foundation that's this size. So thank you. We also know that there have been many, many exciting discussions which indicate that this year will have another very exciting year of growth. And we expect, again, to have a year with, frankly, much more aggressive growth than we've had in the past, and increased contributions. So all good things. So I think we're going to move on now. Thank you so much. And I wanted to just highlight one thing that might be a little bit different, which is you've likely heard from your key contacts at the Jewish Foundation, your philanthropic advisors, that we're really trying to speak more about the role that we play in actually becoming or acting as philanthropic advisors to our fund holders. Many of our fund holders for years and years have been relying on us, as they should, for really professional service, efficient service, good returns, reasonable and low fees, and making sure that we actually facilitate your philanthropy. But what we haven't necessarily done, that we would love to do more of, is give our fund holders access to the expertise and advice and the data that is gathered by UJA's planning team. So most of you know, but some of you might not, that UJA Federation has a team of professionals who are strategists and data scientists. And their job is to go deep into constantly looking at what the issues are in our community. And they have data on the biggest problems, how we can solve them, how philanthropists can make a difference and can target their charitable dollars in the most efficient way, the leanest way, and in a way where possibly there might be leverage available that our fund holders don't necessarily know about when making a distribution. And so we want to make sure that fund holders know that they have access to this information, and that if they have projects that they're looking to distribute to, we are always happy, without question, to continue to facilitate grants anywhere of the fund holders' choosing. But we do have data that we're very happy to share, and advice based on the information that we're getting from this planning team at UJA. And all you need to do as a fund holder is to have a conversation with your key contact at the Jewish Foundation, your advisor, and asking them to either vet an initiative, to provide advice or feedback or questions that you should be asking when evaluating a potential grant from your fund. We are very happy when asked to provide that kind of information to you. And so please know that that exists, and that it's a service that we offer to fund holders. And actually, you're going to start to see that we will be starting to curate opportunities for fund holders to come together, if they want, if they choose, to learn from each other, and to also learn more about some of these areas. And so you'll see that actually we have a first event in a series like this on March 27th coming up, where fund holders will be given exclusive access to information from the UJ planners. There'll be a meeting that we invite you to where we would love you to come and to hear directly from individuals who are running initiatives in these very high priority areas, anti-Semitism, security, things like that, where without any commitment, financial commitment to grants, you can come and you can learn before you make your plan for the year about how you want to make distributions. So I wanted to flag that date of March 27th. And the other thing I wanted to flag was, I think most of you know, we have the Book of Life event every year. It's an amazing event for the Jewish Foundation community and beyond. And that event's going to be taking place on April 8th. Where community members, fund holders, and frankly, the broader community can come together to talk more about the Jewish Foundation, to talk about the legacy we want to leave. It's a beautiful evening, and we've got some fabulous speakers this year on April 8th, so please stay tuned for that as well. So without further ado, I'm going to turn over to Stacy Rosen, who's our new chair of our investment advisory committee. And we're very lucky to have Stacy with us. Stacy's been on the trustees for years now and was vice chair of the IAC and has now taken on her role of chair. She's got 30 years of international experience in capital markets, wealth management, financial risk management. She runs a consulting company offering advisory services we see in risk investments, operations, and financial institutions. You can see here she has 17 years as a derivatives trader, structurer, and institutional client manager. She also has tremendous experience in public and private debt and equity, and she has an MBA space and incredible educational accomplishments as well, including an undergrad from the University of Toronto. I also want to just share, I've spent quite a bit of time with Stacy now, and she's got tremendous commitment to community, understanding of community, has held community roles, has raised a family in the community as well. And so I think, Stacy, we're very lucky to have you on board, both with your financial background and acumen, but also as a dedicated community leader. So thank you so much for taking the time to do what you do. And I'm going to turn it over to you.
Thank you, Sarah, for that very warm introduction. Okay, hello everyone. As Sarah mentioned, my name is Stacy Rosen. I'm honored to be the incoming investment advisory chair. This is the beginning of my 6th year on the committee, and as Sarah mentioned, I've been a foundation trustee for the past year. I am taking over for our past chair, Diana Avigdor, who led this meeting last year, and she also led a very productive 2 years as chair. Big shoes to fill. Thank you, Diana, for your leadership. So for a bit about me, Sarah, thank you for that warm intro on my professional background. I'll tell you maybe things you don't know about me. When I'm not working, I enjoy spending time with my husband and our 2 daughters and our dog, whether in Toronto or at our cottage in Haliburton or visiting friends around the world. And from my background, my interest in supporting the Jewish community goes back to my roots in Kitchener, where I was born and raised. My family was among the original founding members of the community and the synagogue there about 100 years ago. My parents were deeply committed to supporting the Jewish community and its institutions. And I'm so proud to be able to carry on this tradition by my work with the IAC. So for the next 10 minutes or so, I'm going to walk you through the not always glamorous, not always exciting, but very valuable and very necessary how we make the sausage, the kosher sausage, behind the scenes. Okay, so from my seat as chair, I work with each of these groups listed on the left side of the slide. I'd like to tell you a bit about the roles of each of these teams, what they do in managing the foundation's investments, and a bit about the investment process. So the first at the top, the trustees oversee our direction, and they ensure it complies with the foundation's values. The IAC constructs and manages the portfolio. The foundation's incredible professional team, they implement the policies and communicate with fund holders regarding investment management and the philosophy of the fund. And Mercer advises us on all of the above. So on the right side, you'll see the details about the committee. We are 10 seasoned investment professionals, all volunteers. We set the long-term direction of the portfolio through asset mix and asset allocation decisions. We meet at least quarterly, although usually more frequently than that, but at least quarterly to monitor the portfolio performance and adjust direction. The 10 of us work together as a highly cohesive unit, which makes for a very effective team. I would just like to take this opportunity to thank the IAC members who've contributed so significantly to the foundation's investment success to date. So below that, we have a mention of the 3 subcommittees. We meet regularly throughout the year. The subcommittees are made up of committee members who lend their professional expertise into each of these listed categories for a deeper dive. Now, the foundation has a formal investment policy where we lay out our investment objectives, which guide how we invest the portfolio. The objectives have 4 components. earning sufficient returns to offset annual distributions, keeping up with inflation, outperforming the cost of managing our portfolio, and very importantly, building a reserve to grow the portfolio for future generations of our community. So how do we go about investing the funds to meet those objectives? The 5 boxes across the screen here show the main steps we take in the investment process. From left to right, first, determining the optimal asset allocation across the main asset types in our portfolio. Second, ongoing monitoring of the performance of our portfolio and of each of its components. Third, constructing a cohesive portfolio that puts investment managers together, mindful of expected returns and also of risk and correlation. Fourth, operations, the actual nuts and bolts of allocating and moving the dollars around. And fifth, on the far right, aligning our investment decisions to reflect the foundation's values. Each of these steps, as I mentioned before, involves the IAC in consultation with the Mercer team, and of course, in collaboration with the Foundation's finance and investment team. So how has our portfolio done? In 2024, our portfolio is estimated to have gained over 16%, pending final numbers. That is the dark blue bar or column you see on the far left of the page. It was a very strong year for markets, with 70-30 portfolios up between 16 and 21%, depending on the benchmark, which are the bars that you'll see just to the right of that dark blue bar, the light blue and the green bar. Now, of course, over the last 2 years, performance against benchmarks was highly influenced by the Magnificent Seven stocks. So passive index tracking portfolios outperformed active. We are very proud of our performance over the last year. And I'd like to also draw your attention to the 5-year number. That shows our portfolio up over 8% per year on average for the past 5 years. We're keeping pace with those other bars as well, the global markets and the Canadian markets. So something else I'd like to call your attention to that is not on this page, which is any consideration of risk level. So that's on the next slide. We aim to not just produce strong returns over time, which is very important, but also we consider and balance risk. So the previous page showed returns, but this one shows risk level. The dark blue bar at the left is risk. They're measured by standard deviation of returns. So that's how much our portfolio moves up and down month to month compared to global and Canadian markets. You'll see that those dark blue lines, which are the Jewish Foundation numbers, are substantially below the other bars. That's a good thing. In fact, the Foundation is showing risk that is 20 to 30% below those of overall markets. That's a very deliberate strategy on our part, where we prioritize consistency of returns over earnings alone. Because if we can compound consistently, the endowments will do well for our community over the long term, which, as you heard, is one of our main objectives. This slide is another way to look at the power of endowment style investing. Over the long term, it shows the past 25 years of our Foundation's investments. The dark blue line shows the growth of $100 for this 25 years. And from left to right, you'll see that $100 from 2000 to current has grown 4.5 times. Now, the portfolio has changed a lot over these years, of course, but our focus on long-term investing for our community has remained consistent. The dotted green line shows the year-to-year annual return of our portfolio. It's not always a steady ride up from one year to the next, but as we have in the past, we look to accomplish consistent long-term growth to steward these funds for the next 25 years and beyond. With that background on our process and on our results, I'd like to turn it over to the Mercer team led by Texas Hemiplard. Texas has worked with our foundation for over a decade, and he leads the Mercer team, leveraging his many years of experience working with foundations like ours across the US and Canada. He is based in New York City and joins our IAC meetings regularly in Toronto. Mercer has expanded its team over the years, so I would also like to introduce another senior member of the team that you will hear from as well today. Sean Wilkes is based here in Toronto and has over 15 years of experience in markets. He is responsible for working with Mercer's institutional clients across Canada. I would like to hand the next section over to Texas and Sean to take us through a view of markets for the year ahead. Thank you.
Thank you, Stacy, and good afternoon to everybody. Thank you for joining us today. Before we go any further into markets, just to level set for those of you who may not know Mercer, Mercer is a partner to our clients on their portfolios, and those clients number over 1,000 that are just 1,000 that are just nonprofit endowments and foundations like the Jewish Foundation. We're really proud to have been doing this work and working with nonprofits for over 50 years now. Sean and I are here as the team leads for the Jewish Foundation, but of course, we're just two out of a much broader team of over 160 dedicated colleagues who work with us in serving our nonprofit endowment and foundation clients. This next section is really all about the foundation's overall investment strategy at a high level, and then a view of markets. So, really, this first page in this section gets at asset allocation or the asset mix in the portfolio. The most important decision that drives long-term investment outcomes for a portfolio is what investment professionals call an asset allocation, how much to allocate to what main types of investments. So, the subtitle of the slides is underneath the big title there. It summarizes the strategy in words: endowment approach and global diversification. So maybe the first bit there, this is a long-term portfolio. It's an endowment type of portfolio, and it's expected to serve the community in perpetuity. So the approach to investing is really one similar to an endowment. And that second piece, the global diversification part, just means including investments in Canada where it makes sense, and then also diversifying away from Canada to help diversify the risk of just having investments in one country. So the pie chart that's on this page on the left is the long-term asset allocation strategy. These are what we call the targets, where we're headed toward. Starting at the 12 o'clock in the pie and maybe working our way around, you'll see various blue pieces, Canadian equities, international equities, all the way around at the bottom, private markets, and then maybe, I suppose, at 8 o'clock on the pie chart, the liquid real assets. All of those blue pieces of the pie we summarize as growth assets. So in the table just to the right, you'll see you sum those all together and you get to 70% of the assets overall. So this is a growth-oriented type of portfolio consistent with that endowment approach to investing. But markets zig and zag a lot, and so maybe to help mitigate some of that risk, especially in big downturns, there are the gray portions, so the 30% portions of the portfolio there. And there are two pieces: one, risk-reducing hedge funds, and secondly, the fixed income part, which are almost entirely high-quality Canadian bonds. Now, on the far right-hand side of the page is a column that's how the foundation is actually invested as of the end of November. And I think, Stacy, as you mentioned, we're still ticking and tying all the numbers to get the December numbers right, but these are not going to change a lot from November to December. That first number, 55, that's 55% allocated to public equities. And of course, that's higher than the 40% there in the table. That's the target. The next line down is 13% to private markets, and there's a target to 25. So those are the two areas where over the course of the next several years, we're shifting more of the assets away from that top line, the public equities, down to that second line, the private markets part of the portfolio. That's going to take several years to close that gap, and we're expecting, we're working hard and expecting to close that gap there and to make that transition over the course of the next couple of years, really. That's ongoing work with the Investment Advisory Committee. So this is really arguably the most important page around this foundation strategy for the long-term investing. Turning to markets now, and I think that's where we're going to take a step back and then come back to what that means for what the what happens and what the Investment Advisory Committee is prioritizing for 2025 at the end of the webinar here. So, Sean, I'm going to turn it over to you to bring us through markets. Sean.
Thank you, Texas. Thank you, Stacy, and thank you, Sarah, and everyone watching here online for giving me the opportunity to present here today. It's an honor and a privilege. Now, as you can see, broadly speaking, we can describe Trump's policy agenda here as being American growth first, with many of the themes from his first term reemerging stronger than before. So while this slide highlights Trump's policy focus, I think the policy that everyone wants to focus on here is tariffs. And I think it's because they have the potential to hit closest to home. Now, on the campaign trail, Trump had contemplated 60% tariffs on Chinese goods with broad-based 10% tariffs on the rest of the world. And this talk has since changed to 25% tariffs on Mexico and Canada and 10% tariffs on Chinese goods. And this is not a good news story for Canada. 25% tariffs on all Canadian goods would almost certainly have dire economic consequences and potentially, cause a recession. But as we've often seen historically with Trump, what he says and what he does can be two very different things. So we shouldn't necessarily take this outcome as a done deal. The level of integration in Canadian US supply chains, particularly in the auto industry, for example, would make 25% tariffs across the board cause pain not only here in Canada, but also in the US, and it would impact both businesses and consumers. So it's entirely plausible that Trump is simply using the threat of tariffs as the stick to incentivize progress on key policy initiatives. Trump has raised immigration and the export of drugs, particularly fentanyl, as hot button issues that he tied into his recent threats of elevated tariffs. Now, it may be that we're just optimists at heart, but we do like to think that it's unlikely we'll see tariffs go into effect across the board, and instead think that Trump will be similar to his first term and the tariffs will be a bit more focused. So as you can see here, this is what the average US tariff rate would be on total imports under Trump's originally proposed plan. So this was the 10% Canada and Mexico, 60% Chinese goods. And while this original plan is not likely to be initiated, as he's already sort of changed his mind on it, you can see that it would be an extreme change from a multi-century norm. And ultimately, I would say the real certainty of a Trump presidency is uncertainty. And what we inevitably see is sort of tail risks to the macroeconomic outlook as higher than they otherwise would have been. So if we go back to sort of the first thing I said with American growth first, a mix of tax cuts, deregulation, and fiscal spending could be good for US growth. And it's why US equities were higher following the election. But I think when we look at those things, they also have the potential to spur inflation, which could actually hamper the Fed's ability to deliver rate cuts, which drove US interest rates higher post-election in the market. So not what the Fed's doing, but what the actual interest rates that prevail in the market are. And, we also see that, tariffs or the threat of tariffs are providing continued support for a stronger dollar. Now, turning the page to Canada. Canada's leadership is, say, rudderless, somewhat as a result of Trump's declared tariffs. So the tariff announcement seemed to be the final straw in the Freeland-Trudeau relationship. Freeland and Trudeau had disagreed about really providing fiscal stimulus. So the key issues were a 2-month sales tax holiday and a $250 stimulus check to Canadians. Freeland essentially wanted to keep sort of fiscal dry powder available in case Canada gets caught in a tariff war with the US. And she viewed the sales tax holiday and the stimulus checks as a costly political gimmick, not wanting to sort of prop up the economy before it's really needed. So where does that leave our global outlook? Well, developed market central banks are broadly in the midst of easing their policy rates. Australia and Japan are the notable exceptions. But even though those policy interest rates are falling, for the time being, they're at levels that are consistent with dampening growth. So essentially, if we think of a neutral interest rate as something that has no impact on, spurring growth or hindering growth, those rates, even though they've come down, are still higher than that neutral rate. And given the delay that we always see between when interest rates are cut and the savings from a rate cut being passed on to businesses and consumers, central banks are going to need to be careful that they're not too slow in cutting rates. And at the moment, most developed market central banks are expected to bring policy rates back down to neutral levels within the next year or two. And we expect this easing cycle to be facilitated sort of by the disinflation in the labor markets as they continue to normalize, and the easing of interest rates essentially contributing to that normalized growth. So what does normalizing growth look like? Well, it looks different from one economy to another. And we can see here that the US in particular, this is that lighter blue bar, has been running a bit hotter than normal at growth that's in excess of 3%. And we see that slowing down to sort of its more typical long run average of 2%. While other markets, Canada in this magenta bar or pink bar, we would expect to sort of hopefully get back up towards its typical long run target from where it currently is. And central bank easing is going to be the main catalyst of that. I think there's some risk to that we'll obviously be touching on later as well. So, how does this like high level policy rate sort of trickle down and impact the consumers? Well, Canadians at this point are carrying the highest levels of household debt among the G7. And this is amplified by the fact that Canadians are much more sensitive to changes in the level of interest rates compared to our American peers. And this is in no small part due to the differences in mortgage structures. So 2/3 of Canadian debt is owed on mortgages for which the corresponding quote unquote fixed rate resets after 5 years. So I'm sure everyone knows someone who had locked in a mortgage, 4 years ago at a much lower rate than is prevalent in the market now. And if we contrast that to the American norm of having a 30-year fixed rate mortgage, it's abundantly clear why Canadians are much more sensitive to the level of interest rates than their American counterparts. And that's why we're sort of grappling here with historically high mortgage debt service ratios. I think this is also important to point out is how that impacts spending. So carrying elevated levels of debt naturally weighs on one's propensity and ability to consume. And we can see that, in fact, on a per person basis, Canadians have been consuming less than they did in 2019, while our American peers have consistently scaled up their spending. Now, usually this weakness would have had grim economic implications on growth, but it's sort of been offset by aggregate demand in Canada increasing due to the population growth really since 2019. And much of that population growth, and this isn't news to anyone, I'm sure, has been spurred by immigration. So we're going to switch a little bit to inflation. And after having been the star of the show for the last few years, inflation has finally returned to target in Canada. So CPI is sort of the headline number we look at, but that CPI bucket has a lot of underlying components. And sort of during the worst of inflation, we had quite a few of those underlying components growing well above 3%. Now we've seen that share of CPI components growing above 3% return significantly closer to their historic levels, which can be taken as a sign that the broad-based pricing pressures are no longer a concern. And this is a sentiment that's echoed by the Bank of Canada. Of course, the housing affordability crisis continues to manifest itself in the high contribution to inflation from shelter. But even here, I would say that momentum has been ebbing. In the US, we see that inflation has remained a bit stickier than in Canada. I know the print for December just came out a little higher than expected as well. But generally, the 3-month core measure of PCE, which is personal consumption expenditures, is in line with the Fed's target. So sort of looking at what that means for policy rates in the year to come, we put this slide together at the end of November. So our estimates for this 2024 with the Bank of Canada and the Fed were pretty close. The Fed ended up lowering the interest rate by 25 basis points in December, and the Bank of Canada went down by about 50 basis points. And as inflation has ebbed to target, and we don't want to be sort of weighing down growth, we're looking at central banks to sort of continue to cut rates over the next year. But I would say maybe not as aggressively as expected here in the US. I think the latest numbers that I've seen have that being about 50 basis points over about 2 rate cuts. Versus the Bank of Canada, some of the economists are thinking that it could be falling by as much as 1% in 2025. So, a bit of a different story, but, generally rates being decreased over 2025, with the exception of Japan. So, just sort of summarize, as mentioned earlier, the current base case for the economic outlook comes with the big caveat of what will Trump do? The US is adopting protectionist policies, and that's naturally going to prompt retaliatory measures from their trading partners. And that's ultimately going to weigh on growth. And I think it poses an upside risk to inflation. For now, it's impossible to say exactly how that risk will play out, but in the interim, markets are sure to be impacted by heightened levels of volatility in the face of this uncertainty. And as we sort of talked about with the private markets, this is another sort of good reason for the foundation being invested in those private markets to sort of help dampen that volatility. So, the other thing we're looking at here is China growth. And in China, while it appears the economy has bottomed out, the timing of an improvement in consumer and business sentiment there is impossible to predict. And given the potential tariffs on Chinese goods, the economy would need to be, or the growth of the economy would need to be more reliant on domestic consumption. And we see that as a key risk in the year ahead, especially as their property sector continues to struggle. Now, finally, while growth concerns have sort of moved to the forefront as central banks ease their rates globally, and some new fiscal measures are contemplated, I think there still remains the risk that inflation could pick back up, especially if there's any sort of trade war. So, focusing again on Canada, we touched on this earlier on the role of immigration and how that has supported growth post-pandemic. As immigration policies tightening, we do see a risk of decline in the rate of population growth. And recent changes in immigration policy are projected by the government to yield slight declines in the population over the next 2 years. And while it seems unlikely that the government's ambitious targets will be realized as quickly as projected, it's almost a certainty that we're exiting that period of high population growth experienced post-pandemic. So that ebbing of population growth can matter less if Canadians begin to spend more. So if we see that per capita spending in Canada increase, then things will be okay. But with the high levels of debt that Canadians are under, I think interest rates are really going to need to fall so that they're able to increase their spending. The timing of when that might take place is unknown, and delays in the pass-through of interest rate cuts to spur that consumption could weigh on growth. And on the inflation side, I would say it's sort of two-sided in Canada. There's now concern that inflation may run above or below target. 2% is the inflation target typically. On the upside, we have the geopolitical risks with tariffs and through the service channel, notably housing and wages. On the downside, the aforementioned risks to consumption could drag inflation lower if there's just no spending and no demand. So while inflation had been sort of the prominent concern for the last few years, I would say risks to growth have now moved to the forefront. So turning now to what that potentially means for the portfolio, I'll say we're focusing on long-term assumptions, but when we look at those long-term assumptions every year, our long-term assumptions this year are a bit lower than they would have been last year. So Texas and I work with Stacy and the Investment Advisory Committee to model those long-term expected returns every year. And while the projections typically don't change much from year to year, I'll say the number we're focused on is the bottom of this table, this 6.9%, and that's the long-term median annual return for the foundation. And sort of Texas had talked about the private markets, so that's highlighted with these 3 boxes here, and you can see, we're growing these investments deliberately, and we're doing it essentially because they have the highest expected return. And shifting the foundation's allocation here will boost the long-term prospects for the foundation. Now, to end the webinar, I'm going to turn it back to Texas to take us through our views for the top considerations for foundations in 2025.
Thank you, Sean. And Stacy, you and I are going to end this out. And then we've got Q&A. I might just take a pause here for folks who have questions. Feel free to put it in the Q&A you should see in your Zoom window there, or if you're looking on a small screen, a button that says Q&A. You can type a question there. You can also put it in the chat, although the Q&A is a little bit easier in terms of organization and making sure that we're addressing everyone's questions. So we'll come back to that in just a few minutes here. Sean, you talked a little bit about what's happening more recently and then ended with the long term. Stacy and Sarah both talked about long-term investments, and I did as well on asset allocation. We're investing for the long term, and as you've heard, that's important to the community and to the portfolio. It's important to at least acknowledge, though, if not also address trends in markets, and that's why Sean, you went through a number of things that I want to make sure we're taking into consideration. At a big picture level, there's a lot on this slide. There are really 4 main themes as we at Mercer work with our endowment and foundation clients in 2025. And I might just walk through the main, maybe the boxes that are in the colors here on the left-hand side. First, broaden asset class exposure. Portfolios have sometimes deliberately, but sometimes not deliberately, just become increasingly concentrated in the U.S. It is because of those magnificent 7 stocks that have performed so well. It's been driving overall market gains and also the concentration a bit. So that outperformance can't really continue forever. And so the action points on the right-hand side of the page there are really what's in place to address those risks. Refreshing asset allocation studies, broadening investments, and these sorts of things are occurring already as part of the foundation's fiduciary process every year. Second, on the left-hand side there, you'll see evaluate opportunities to enhance private markets programs. You heard me say originally on asset allocation that we're moving more into private markets over a period of years. And it's not just moving to everything that's in privates, but being deliberate and having a strategy there. The implementation items on the right side of the page next to that second box really are what we'll be working on with the private markets subcommittee and the full investment advisory committee as we make our way through 2025 and the next couple of years. Back on the left, third, optimize your governance budget. We've done some studies on effective governance, and really what's come out of that is what we can call a return on governance. By having a good decision-making process in place, investors generally actually are able to earn a little bit more. So having that strong governance is really important. Now, I will say the Jewish Foundation here already implements many of the best practices that we see, and our work, Stacy, with you and the Investment Advisory Committee will be more tweaks around the edges rather than drastic changes here for the Jewish Foundation. And then finally, in the lower left corner of the page here, address values alignment objectives in the IPS or in the investment policy statement. And here is where I do think the Jewish Foundation is actually ahead of many peers in that there is a value statement in the investment policy. And there have been some things that have come out of that have been very actionable. And actually, it's going to continue to be a priority for 2025 as we make our way forward. So that's those are really the big picture, the top considerations that we see for endowments and foundations in this year here so far, of which is just January. I think we'd like to end with a little bit of a look back, a little bit of a look forward, key accomplishments in 2024 last year, and also what's ahead for priorities in 2025. And Stacy, I think I'm going to turn it over to you for that next and last slide of the formal presentation. Stacy?
Thank you. Hopefully you can hear me here. Thank you, Texas and Sean, for your presentations. And thank you to you and the entire Mercer team for the work you do with us in collaboration with us in support of achievement of the Jewish Foundation's objectives. So in terms of 2024, it has been a busy year for the IAC, a very busy year. In addition to our financial results, we are also proud of 3 main accomplishments in the that you'll see in the top section of this slide. First, we did a full review of our traditional public markets equity portfolio. The committee, and especially a subcommittee, spent many hours analyzing our strategy. So that was where to be active, where to be passive, and how we should allocate to different geographies around the world, especially in the context of active versus passive. At the conclusion of our review, we ended up making changes to the active passive tilt in the portfolio and also to our investment manager lineup. And in the process, we reduced our already low investment management fees by another $700,000 annually. Second, in private assets, early in the year, we reviewed our private equity and private debt target allocations, and we analyzed them against different economic and market scenarios to optimize the overall asset mix. Then, during the year, we approved approximately $66 million of commitments to multiple managers as part of the steady growth of our private markets, which you've heard of recently from Texas and from Sean. And third, we actively engaged with investment managers in our portfolio, those who were supportive of Israel and those who acted contrary to Israel. So I'll just address this point a little further. Our investment values and strategy have us focused on making sure we are invested in managers who either support Israel, and we declare to them before we invest with them that we will not invest in any managers who have any kind of BDS stance or any kind of anti-Israel stance. And if we come across one that is considering or speaking about it or invested in anti-Israel type activities, we have a protocol to go through to address and or disinvest. So that was something we actively engaged in this year as an example. Now, Texas mentioned, if I move on to the priorities for 2025, Texas mentioned some things we'll be considering. We have 3 top priorities that I'd like to highlight for you in the bottom half of the screen. First, we plan to continue to review our fixed income strategy, given the changing landscape for interest rates and inflation, as you've heard from Sean. Second, we will continue to steadily ramp up our private markets opportunities in credit, equity, and real estate. And third, we are going to spend some additional time looking at the foundation's value-aligned strategy. So this relates to what I mentioned we were active in 2024, and we will continue to grow this in 2025. In 2024, we symbolically added an increase in Israel-based holdings. We will continue to explore ways of aligning our investments with the foundation's mission and values. So in some cases, we can look at specific investments related to Israel, but we do have criteria that make sure for us to make sure that they are valued and valuable, that we can see the value on a regular basis. So we have criteria, but we do look to build that ability and exposure to Israel-based investments. So in closing, I'd like to just mention to our fund holders that the teams here represented today are committed to stewarding your generous donation dollars so they can grow to have the greatest impact possible. Thank you to our fund holders. Your dedication to our community is really unparalleled. And now, with the formal presentation completed, we welcome your questions. I will turn it over to Texas to lead the Q&A.
Thank you, Stacy. I see a few questions that have come in, so I'm going to try and prioritize maybe a data-oriented question. Does the foundation invest in China? I'm just going to say not directly, no. There is no dedicated piece of the portfolio that's assigned to be allocated to China. There is a very small, and it's a few percentage points of the portfolio that's allocated to broad emerging markets, of which China is one of them. So I don't want to say that the exposure to China is de minimis, but it is the decision of an investment manager that's hired to look at not just China, but all emerging markets, and all of that is quite a small part of the overall piece of the overall portfolio. I think, let's see, There's another question around, well, Stacy, I think you answered it, which was around the direct investments. Do we make, do we make, does or can the investment committee make one-off investments, or does it only allocate to other investment managers? Don't know if there's anything you'd want to add on that one.
No, just that we can. We don't have to allocate to managers. We have criteria to make sure that that operationally those assets can be valued. So you can't skip forward 10 years, not have a value in that asset, and then find out 10 years later. Just practical things to make sure that they are safe for our donor advised funds. But yes, we can make direct investments.
Yeah. Wonderful. There's a question that Stacy, you addressed part of this, the Jewish Foundation stance on investments in Israel. How does it deal with investments associated with anti-Semitism or anti-Israel? I think you addressed the allocation and the piece to Israel. Just that there is a monitoring process I might just share with everybody around, which is in the policy of the Jewish Foundation of not investing, as you mentioned, Stacy, with managers that have companies that might be supportive of BDS, the boycott, divest, and sanctions, which is essentially an anti-Israel stance. Perhaps I can share without going into too much detail. There's a CEO of a company that was in one of the portfolios that one of the managers that the Jewish Foundation had that didn't explicitly say his company or the company was adopting BDS, but his comments were public and were quite anti-Israel. There was a bit of work that we did to inform the foundation, and some communication that between us, Mercer, and the Jewish Foundation with this manager to make sure that they understood that they're investing on behalf of the Jewish Foundation, and that those even just comments, even informally by the CEO, were completely unacceptable. So that investment is no longer part of the overall portfolio for reasons I won't necessarily go into, but it's those sorts of things that we do monitor. And that's a very important part of not just controlling risk and earning high returns for the community long term, but do so with an alignment to the values that the Jewish Foundation has. Let's see. There's another question that, Sean, I might turn to you around illiquid investments with 25% target. I'll just add that in private illiquid investments, how can we ensure that there's enough cash available to pay grants in times of great need?
Sure, thanks, Texas. So, what we do is we'll stress the portfolio to make sure that, if private markets valuations collapsed and they weren't liquid, that the public part of the portfolio would be more than sufficient to actually pay out those grants. So we'll actually look at it as if the foundation had no cash flows to really stress the scenario. And the 25% is not a level there that would cause any stress given sort of the payout level, and especially with the Jewish Foundation where there's constantly flows coming in, that really helps alleviate the concern.
Wonderful. Hopefully we're answering all the questions that are coming in. I don't see any questions that we can't answer. Right now, there's just one other. So we'll address that. Again, if you have a question, you can put it in the chat. You could also importantly, maybe put it in the Q&A piece here. There's a question that how does the foundation compare in performance to other foundations? Perhaps I could take that, and Stacy, if you have anything to add afterward here. But the first thing I'd say is that we do care about what other foundations are doing, primarily because I think we're all an ecosystem and a community of nonprofits, and it's what I've spent my entire career working with, and which are endowments and foundations. And I think it's important to share best practice across the board. And part of that is comparing performance. At the same time, we are not comparing performance against others for the sake of just outperforming them, because of course we're structured differently here than we are with a say, a private foundation where the grant needs are very known far in advance and there's no surprise grant needs, as opposed to a community foundation, which a Jewish foundation is, and there are times when grant needs might be higher or lower, so that affects things. So I haven't quite yet answered the question, but the answer to the question is we look at this every year, and we're just about middle of the pack, sometimes at the high end in terms of return, when we look at overall global endowments and foundations. And I'd say that when we look at Canadian endowments and foundations, the relatively low allocation to Canadian equities helps a lot when non-Canadian equities are doing really well. And in those times, the Jewish Foundation is doing quite a bit better than Canadian endowment and foundation peers. And it works the other way too. When Canadian stocks are outperforming, we might be underperforming some of the Canadian-only foundations that we work with. But again, we're trying to keep an eye on what everyone is doing, but we're not using this, peers as necessarily a benchmark. Stacey, I don't know if there's anything you'd add there.
No, I think you covered it.
Wonderful. Okay, I don't see any other questions. Let me just double check here. So with that, perhaps, Stacey, I can turn it to you to close the webinar here. And just from my perspective, thank you all. It's wonderful to be working with the Investment Advisory Committee and with the foundation on behalf of our team at Mercer.
Thank you, Texas. On behalf of the Investment Advisory Committee and the Jewish Foundation, we all appreciate your interest in what we do, and especially the support you provide through the Jewish Foundation to our community. So thank you for joining us today.